Next week's economic calendar is packed, and markets will be highly sensitive to data surprises. Key economic data release Friday 3/7 U.S. Employment Report. This non-farm payrolls report is arguably the most important data point of the month. January jobs data. Recap plums on 43,000 jobs added below expectations. Unemployment rate dipped to 4.0%. February forecasts. Job gains expected in the 100,000–150,000 range. Unemployment to hold around 4.1%. Recent layoff announcements and weaker confidence add uncertainty. Potential market reactions. Weak jobs report 100K jobs. Recession fears could increase, but a Fed pivot rally may emerge if markets expect rate cuts. Strong jobs report to 00K jobs. Lower unemployment could spook markets, suggesting the Fed may stay restrictive longer. Key focus average hourly earnings. Wage inflation edged up to 4.1% YoY in January. Any further acceleration may reignite inflation fears. This jobs report could be a major driver for market sentiment and Fed policy expectations next week. While Friday's U.S. jobs report will be the headline event, several key economic data releases earlier in the week could also shape market sentiment. Key economic data releases Monday 3/3 ISM Manufacturing PMI measures whether the manufacturing sector remains in contraction. Last reading 47 Wednesday. 305 ISM Services PMI and Global PMI surveys. Flash PMI data show declining services employment. A weaker than expected ISM services number could weigh on markets. Central bank and Fed policy. Fed watchers will pay attention to Chair Powell's public remarks. While no major speeches are currently scheduled, any updates on economic conditions will be key. Thursday 3/06 European Central Bank ECB meeting. A surprise ECB rate hike or dovish stance could influence global bond yields and the US dollar. Market implications and strategy. Next week's data could either reinforce or challenge the recent economic slowdown narrative. Markets favor a Goldilocks scenario. Cooling inflation without collapsing growth. Bond market reactions will be critical. If yields spike on strong data, expect stock market pressure. If yields decline, equities may stabilize. Next week, U.S. equities approach a critical technical juncture, with key support and resistance levels in focus. S&P 500 technical outlook. The S&P 500 closed in the mid-5900s, about 3% below its all-time high. 6,070 on Feb 19. Dipped below the eyes our 50-day moving average during the sell-off, but recovered on Friday's rally. Key technical levels: resistance 6,000 psychological level and 670 record high. Support 5,850 recent low and prior consolidation zone from December. Nasdaq Composite and Russell 2000 performance. Nasdaq Composite down 3.5% this week, testing its 100-day moving average, percent off its recent peak. Key to iWatch: if momentum stocks stabilize or keep falling. Russell 2000 small caps underperformed in February, approaching 10% correction territory. Further weakness may signal rising risk aversion, while stabilization would support broader market strength. Market breadth and sentiment. Market breadth deteriorated. More new lows than new highs midweek. Bulls will want to see broader participation in rallies, not just big tech leading. In summary, next week's market action will be crucial in determining whether bulls can reclaim momentum or if downside pressure persists. This week, volatility, technical signals, and key inflection points will be critical for traders. Volatility -1 and market sentiment. VIX is now below 20. A further drop toward 1517 could signal complacency. A spike back above 22 to 25 may indicate another downside move for equities. Technical indicators and key market levels Schwab's technical strategist, noted that multiple indicators reached oversold territory. Midweek short-term oscillators and put-talk call ratios suggested a bounce, which materialized by Friday. Key technical inflection points for traders. If S&P 500 fails to hold 5E900, investors may reduce equity exposure or add hedges. If S&P 500 clears 6,000 again, it could trigger momentum buyers. Risk management and trading strategy. Given recent fast swings in the market, many are advising smaller position sizes to reduce risk. Wider stop losses to avoid getting whipsawed. Next week's market moves will largely depend on how these key technical and volatility levels play out. This week market sentiment shifted from exuberance to a more neutral stance, with investors adopting a barbell approach to positioning. Market sentiment and investor positioning. AII Investor Sentiment Survey. Bullish sentiment declined. Bearish sentiment ticked up. No extreme fear observed. VIX and other volatility gauges only saw moderate spikes. Fund managers' response: many are still holding cash after reducing exposure in February's pullback. If further weakness occurs, dip buyers may step in, providing market support. Investment strategy: the barbell approach. Maintain exposure to quality growth stocks. Growth stocks that sold off may rebound quickly if markets recover. Increase exposure to defensive value sectors, healthcare staples, and utilities. As a cushion against economic uncertainty, healthcare stocks remained relatively stable this week and could outperform if growth fears rise. Key sector focus: financials and energy. Financials yields are down, and an economic slowdown looms. Large cap banks may present value opportunities, but credit risks remain uncertain. Energy: China's National People's Congress next week may introduce pro-growth policies, potentially boosting oil demand. Oil prices have been quiet, but OPEC or geopolitical news could make energy a wild card sector. Overall, investors are watching for market stabilization while maintaining a balanced portfolio approach. Beyond scheduled economic events, investors should keep an eye on unscheduled developments that could drive market volatility. Key risk factors to watch: tariff and trade announcements. Trump administration's tariff implementation on North American goods is set for next week. Any retaliation from trade partners could impact industries like autos and agriculture. Ukraine-Russia conflict. Tensions remain high after the Trump-Zelensky meeting. Any geopolitical developments could move defense stocks or oil prices. Global PMIs and economic slowdown. European and Asian PMIs will reveal whether global economies are slowing. Weak overseas data could impact U.S. multinationals. Outlooks: Chinese yuan and emerging market currencies. Heightened volatility in M currencies and U.S.-China. Tensions, e.g. over chips or Taiwan, could drive safe haven flows to the dollar. Stronger dollar may pressure commodities and U.S. exporters. Stock buybacks and insider selling. Buyback blackout window is ending. Companies may resume share repurchases, boosting demand for equities. However, insider selling may rise if executives believe stock prices have recovered enough. Tracked via SEC filings. Overall, investors should remain vigilant for potential surprises that could impact market sentiment next week. As the market enters next week, tentative optimism is emerging after Friday's bounce, but investors have plenty of homework ahead. Key investment strategy and market outlook. Adopt a data-dependent approach. Wait for key economic data, ISM jobs report, before making major allocation shifts. These reports could confirm or disrupt the current market narrative. Maintain hedges. Many investors may keep hedges puts. Inverse ETFs ahead of the payrolls report due to market risks. Buying the dip versus deeper pullback risk. Some may use the recent dip to add high conviction positions, arguing that corporate fundamentals remain strong. Potential Fed easing later this year could be a market tailwind. However, technical and macro indicators are at a crossroads. Is this a healthy correction in a bull trend, or the start of a deeper pullback? This week's data will be key. Watch corporate earnings and jobs data. If Broadcom and Costco post solid earnings, and the jobs report shows neither overheating nor collapse, markets may resume an upward grind. Stay nimble, watch data, and maintain a long-term view. Closely monitor news feeds and data tape to recalibrate positions. Above all, maintain a balanced long-term perspective. Despite short-term noise next week, the burden of proof is on the bears to justify further downside, making data releases crucial for market direction. If you still want to receive U.S. stock information next week, please subscribe and hit the alarm button. Thank you for watching and see you next week.